Trump stood at the podium in 2019 and said it plain. Wall Street is funding our enemy. He wasn't talking about terrorists. He was talking about China. And how did the biggest financial titans in America respond? They laughed. They called it protectionism. They said he didn't understand economics. And quietly, they poured more money into China. So what if the reason wasn't that they didn't understand, but that they understood too well? What if betting on China wasn't just an investment strategy, but a mechanism designed to chain America's financial future to Beijing? What if your retirement account, the one you've been faithfully funding every month, is only safe as long as China's economy hits the exact growth targets set by the Chinese Communist Party? You're working harder, but saving less. Prices keep climbing. Your salary can't keep up. Retirement keeps getting pushed back. They tell you it's inflation, economic cycles, aging demographics. But what if the truth is simpler? What if the wealth that should have stayed with you was exported to Chinese markets and rebranded with a sophisticated name? Portfolio diversification. Drop a comment right now. Where are you watching from? And if you want analysis that isn't sanitized, that isn't sugar-coated, hit subscribe for the unfiltered truth about how the financial system actually operates. Because what's coming isn't conspiracy theory, it's structure. And once you see the structure, you'll never listen to financial news the same way again. Now let's follow the money. The year is 1997. Hong Kong reverts to Chinese control. The world watches nervously. Will Beijing honor the one country, two systems promise? Will markets collapse? Will capital flee? Instead, something unexpected happens. Western banks start drawing up plans, not exit plans, entry plans. Goldman Sachs opens its Beijing office in 1994, 3 years before the handover. Morgan Stanley follows. By 2001, China joins the World Trade Organization, and Wall Street throws a party. The official narrative was simple. 1 billion consumers, untapped markets, the next great growth story. But here's what they didn't advertise. China had a legal problem. Their own constitution forbids foreign ownership of strategic industries, telecommunications, technology, media, energy, all the sectors where real money gets made. Foreign investors were legally barred from owning these companies. Sound familiar? When you can't own something directly, you create a shell structure. You build a legal fiction, just like the mortgage-backed securities that hid subprime risk, just like the special purpose vehicles that Enron used to hide debt, just like every financial innovation designed to bypass regulation and accountability. Enter the variable interest entity, the VIE. In 2000, a law firm in the Cayman Islands files incorporation papers for something called Sina Corporation. It's a shell company, no employees, no revenue, no actual business, but it has contracts. Contracts with a Chinese company called Sina. Com, that actually operates the business in Beijing. The Cayman shell doesn't own the Chinese company. It can't. That would be illegal under Chinese law. Instead, it has agreements, service agreements, profit-sharing agreements, control agreements. Technically, the Cayman entity owns nothing. Legally, it controls everything. Sina goes public on the NASDAQ in April 2000. American investors buy shares in a Cayman Islands shell company that holds contracts with a Chinese entity they can never legally own. The company raises $168 million. Wall Street calls it innovation. Sound familiar? When Glass-Steagall was repealed in 1999, they told us breaking down barriers between commercial and investment banking would increase efficiency. What it actually did was let banks gamble with depositor money while hiding risk in off-balance sheet vehicles. Same playbook, different decade, same outcome. Socialized losses, privatized gains. By 2005, every major Chinese tech company follows the VIE structure. Baidu, Alibaba, Tencent, JD come out on our NetEase. These aren't fringe players. These are the Chinese equivalents of Google, Amazon, and Facebook. And every single one is technically owned by American investors through Cayman shell structures that exist in legal limbo. Chinese regulators know about this. They're not stupid. They allow it because it serves their purpose. Capital flows in. Technology transfers happen. Western expertise gets imported. And if Beijing ever changes its mind, they can simply declare VIE contracts unenforceable under Chinese law. Every legal expert knows this. Every prospectus discloses this risk in fine print. But here's the thing about disclosures. Nobody reads them. Sound familiar? Before 2008, mortgage documents disclosed that loans could be bundled, sliced, and sold to investors worldwide. They disclosed that credit ratings might be inaccurate. They disclosed that housing prices could fall. The disclosure was there. The crisis happened anyway. Because disclosure without comprehension is just liability protection for the people engineering the risk. By 2014, more than $200 billion of American investment capital sits in Chinese VIE structures. The number keeps growing. Pension funds, university endowments, sovereign wealth funds. They all want exposure to emerging markets. They all want growth, and Wall Street is happy to provide it for a fee. But there's a second mechanism, one that's even more insidious, one that makes the entire system irreversible, and you won't believe the name behind it. June 2018, the height of the trade war. Trump imposes tariffs, China retaliates, markets wobble. Politicians on both sides demand decoupling, divestment, economic separation. And in the middle of this theater, something very quiet happens. MSCI, the company that creates the indexes your retirement fund tracks, announces that Chinese A-shares will be added to its emerging markets index. Not the Hong Kong listings, not the American depository receipts, actual mainland Chinese stocks traded in Shanghai and Shenzhen. If you don't know what MSCI is, you should. Morgan Stanley Capital International. They create the blueprints that $12 trillion in global assets follow. When MSCI adds a stock to an index, passive funds must buy it. Not because they want to, because their mandate requires them to track the index. This is the second mechanism, the one that turns voluntary investment into structural dependency. Passive investing now represents over 50% of all U.S. equity assets. Index funds, ETFs, target date retirement funds. They don't pick stocks, they replicate indexes. And when the index changes, they must rebalance, automatically, mechanically, without human judgment. So when MSCI adds Chinese stocks, billions of dollars flow into China, not because any fund manager decided it was smart, but because the index demanded it. Let me say that again. Your 401k is buying Chinese stocks, not because your advisor thinks it's a good idea, but because a company you've never heard of changed a formula that your passive fund is contractually obligated to follow. By 2019, MSCI increases the weighting of Chinese A-shares in its indexes 4 times in a single year. Each increase triggers another wave of forced buying. Another few $1 billion flooding into Shanghai. Pension funds, state employee retirement systems, teacher retirement funds. All flowing into companies that American investors can't actually own, governed by laws they can't enforce, operating in a country that openly declares itself a strategic rival. Trump tweets about China, imposes sanctions, restricts Huawei, bans TikTok, and your retirement account keeps buying. The engineers of the system knew exactly what they were doing. They weren't just creating investment products, they were manufacturing dependency. They were making decoupling impossible. Because once American retirement solvency is tied to Chinese stock performance, threatening that relationship becomes political suicide. This wasn't an accident, this was architecture. And the receipts are wilder than you think. Let's break down exactly how this machine works. Because once you see it, you can't unsee it. Start with the variable interest entity. It's beautifully simple in its deception. A Chinese company, let's call it Dragon Tech, wants to raise money from American investors. But Chinese law prohibits foreign ownership of internet companies. So Dragon Tech's founders create a Cayman Islands shell company called Dragon Holdings. Dragon Holdings is technically a separate entity, different jurisdiction, different ownership structure. Dragon Holdings then signs a series of contracts with Dragon Tech, a management agreement that gives Dragon Holdings control over business decisions, a loan agreement that funnels profits from Dragon Tech to Dragon Holdings, a call option that allows Dragon Holdings to purchase Dragon Tech's assets if Chinese law ever changes. On paper, Dragon Holdings owns nothing. In practice, it controls everything. American investors buy shares in Dragon Holdings on the New York Stock Exchange. Their money flows to the Cayman entity. That money then flows to China as loan proceeds or service fees. Dragon Tech operates in Beijing, generates revenue, and sends profits back to the Cayman shell, which distributes them to American shareholders as dividends. Everybody wins, except for one small problem. If the Chinese government decides these contracts are invalid, American shareholders have zero recourse. Chinese courts don't recognize Cayman Islands judgments. The contracts themselves specify that disputes will be resolved under Chinese law and Chinese courts. And the Chinese Communist Party has made very clear that it views law as a tool of state power, not an independent check on it. Every legal expert knows this risk. But here's the parasitic genius of the model. As long as money keeps flowing, everyone has an incentive to pretend the risk doesn't exist. The Chinese founders get rich, Wall Street collects fees, American investors see returns, and the fundamental legal fiction at the heart of the structure remains unexamined. Until it doesn't. In July 2021, Beijing bans for-profit tutoring companies. Overnight. No warning. Companies like TAL Education and New Oriental Education and Technology see their stock prices crater 90%. American investors holding these VIE structures lose billions. Pension funds, retirement accounts, university endowments. Did Chinese regulators violate the VIE contracts? Technically, no. Because the contracts never guaranteed that the underlying Chinese business would be allowed to operate. They just promised that if profits existed, they would flow through the structure. No profits, no problem. For China, sound familiar? When Lehman Brothers collapsed in 2008, counterparties discovered that their credit default swaps were only as good as Lehman's ability to pay. The contracts existed, The enforcement didn't. Same principle, different players. But the tutoring ban wasn't the end. It was a warning shot. By 2022, over $1 trillion in U.S. capital sits in Chinese VIE structures. The number is almost incomprehensible. $1 trillion in investments that exist in legal limbo, dependent on the goodwill of a foreign government that views the United States as a strategic competitor. Now add the second mechanism, the passive investment pipeline. In 2018, when MSCI first includes Chinese A-shares in its emerging markets index, the initial weighting is tiny, 0.73%, barely noticeable. But MSCI announces a roadmap. The weighting will increase gradually until Chinese stocks represent their full market capitalization. Weight in the index. What does that mean in practice? China's stock market is the second largest in the world by market cap. If weighted purely by size, Chinese stocks should represent roughly 40% of the MSCI Emerging Markets Index. 40%. Let that sink in. Any American with a target date retirement fund, any state pension with emerging market exposure, any endowment with a diversified portfolio would eventually hold 40% of their emerging market allocation in Chinese stocks. Not because they chose it, because the index formula demanded it. By June 2019, MSCI has quadrupled the weighting of Chinese A-shares to 3.3%. Each increase triggers what's called rebalancing flow. Index funds must buy Chinese stocks to match the new weights. In the first phase alone, passive funds pour $13 billion into Shanghai. Who benefits? The investment banks facilitating the trades, the Chinese companies getting capital inflows, the index providers collecting licensing fees from every fund that tracks their benchmarks. Who bears the risk? You, the end investor, the teacher whose pension owns an emerging markets fund, the engineer whose 401k includes a target date 2040 fund, the university whose endowment follows modern portfolio theory. The genius of this structure is its automaticity. There's no vote, no debate, no democratic input. An index committee at MSCI meets, changes a formula, and billions of dollars move. Mechanically, irreversibly. By 2020, U.S. institutional investors hold over $800 billion in Chinese equities through both VIE structures and direct mainland listings. The Congressional Research Service publishes a report warning that this creates strategic vulnerabilities. That American capital is now subject to Chinese regulatory risk, geopolitical risk, and accounting fraud risk. The response from Wall Street is immediate and coordinated. Ray Dalio of Bridgewater Associates goes on television and says anyone not invested in China is making the tragic mistake. Larry Fink of BlackRock writes an op-ed calling China a significant opportunity for investors. BlackRock alone manages over $10 trillion in assets. When Larry Fink speaks, markets listen. But here's what Fink doesn't mention in his op-ed. BlackRock earns fees on every dollar it manages. If Chinese stocks perform well, those assets grow, and BlackRock's fees grow with them. If Chinese stocks collapse, BlackRock still collects management fees on the way down. The incentive structure is clear. More assets under management equals more revenue. Risk is transferred to the client. This is moral hazard in its purest form. The people engineering the exposure don't bear the consequences of failure. Investment banks earned fees for securitizing those mortgages regardless of their underlying quality. Rating agencies got paid to rate those securities regardless of accuracy. Everyone in the chain had an incentive to keep the machine running, right up until it exploded. Let's talk specifics, because the scale of this wealth transfer is staggering. In 2010, total U.S. investment in Chinese equities was approximately $237 billion. By 2020, that number had grown to over $1.1 trillion. That's a 464% increase in a single decade. Where did that money come from? Pension funds account for roughly 30%. Mutual funds and ETFs, another 45%. The rest is hedge funds, endowments, and sovereign wealth funds. Here's the breakdown. CalPERS, the California Public Employees Retirement System, the largest pension fund in America, held over $9 billion in Chinese investments as of 2020. The Florida Retirement System held over $3 billion. The New York State Common Retirement Fund held over $4 billion. These aren't rogue investors. These are the pension systems that millions of teachers, firefighters, and state employees depend on for retirement security. And every single one of them is now exposed to risks they cannot control. In March 2020, the Federal Retirement Thrift Investment Board, which manages the retirement savings of federal employees and military personnel, announced plans to shift its international fund to track an MSCI index that includes Chinese stocks. The move would have automatically invested billions of federal employee retirement dollars into companies like Hikvision, a surveillance technology firm blacklisted by the U.S. government for human rights abuses. The backlash was immediate. Senators from both parties demanded reversal. In May 2020, the board delayed the change, but the fact that it was even proposed reveals the depth of the problem. The machinery of passive investment was leading fiduciaries to invest retirement savings in companies directly at odds with U.S. national security interests, because the index said so. By 2021, Chinese companies had raised over $70 billion through U.S. capital markets via initial public offerings and secondary offerings. Didi Chuxing, China's version of Uber, raised $4.4 billion in its New York IPO in June 2021. Days later, Beijing banned the app from Chinese app stores and launched a cybersecurity investigation. The stock collapsed. American investors lost billions. Did Didi disclose the regulatory risk? Yes. Page 87 of the prospectus mentioned that Chinese regulators could take action that would harm the business. The disclosure was there. The loss happened anyway. Because disclosure is not protection. It's a legal shield for the people selling you the risk. Now let's talk about something even more insidious. The numbers themselves might be fiction. Chinese companies listed in the US are required to file audited financial statements. But here's the catch. The audits are performed by Chinese affiliates of major accounting firms. PricewaterhouseCoopers, China, KPMG China, Deloitte China, and Chinese law prohibits these firms from sharing their work papers with U.S. regulators. The Public Company Accounting Oversight Board, the U.S. regulator responsible for auditing oversight, has been trying to inspect Chinese audit work for over a decade. China refuses access. Every single time. So when you look at the financial statements of Alibaba or Baidu or any other Chinese company, you are trusting an audit you cannot verify. Performed under standards, you cannot inspect in a jurisdiction that treats law as a political instrument. In 2020, the U.S. passed the Holding Foreign Companies Accountable Act. It requires foreign companies to allow PCAOB inspections or face delisting after 3 years of noncompliance. It was supposed to be the solution. But by the time the 3-year clock runs out, how much more capital will have flowed into these companies? How much more structural dependency will have been created? And when delisting finally happens, who absorbs the losses? Not the investment banks that collected fees, not the index providers that included the stocks, not the executives who sold shares at the peak, the teacher in Ohio whose pension owned an emerging markets fund, the engineer in Texas whose 401k tracked the MSCI index, the retiree in Florida whose advisor promised diversification. This is engineered wealth extraction disguised as modern portfolio theory. But the final piece is the most disturbing, because this isn't just about money, it's about power. When American pension solvency becomes tied to Chinese economic performance, what happens to policy? When CalPERS has $9 billion invested in Chinese equities, how hard will California politicians fight to protect those investments? When federal employee retirement funds hold Chinese stocks, how aggressive will U.S. policy toward Beijing be? This is leverage by design, and Beijing knows it. In 2020, China's foreign ministry spokesperson was asked about U.S. threats to delist Chinese companies. His response was telling. He said such actions would harm the interests of investors around the world, including those in the United States. Translation: you can't afford to hurt us without hurting yourself. That's not a market relationship. That's a hostage situation. And the hostages are your retirement accounts. By 2022, after the Russian invasion of Ukraine, when Western investors fled Russian assets and wrote off billions in losses, a disturbing question emerged. Could the same thing happen with China? If Beijing invades Taiwan, if the U.S. imposes sanctions, if assets are frozen, what happens to the $1 trillion of American capital invested in Chinese markets? Financial analysts started running scenarios. The estimates range from catastrophic to apocalyptic. Because unlike Russia, where U.S. exposure was measured in tens of billions, Chinese exposure is measured in trillions. The collapse wouldn't just hit hedge funds, it would crater pension funds, state retirement systems, university endowments, the entire architecture of American retirement security. This is what irreversible means. The system has been built so that failure is no longer an option. Not because the investments are sound, but because the exposure is too large to survive. This is too big to fail on a civilizational scale. So here we are, December 2025. The trade war is theater, the decoupling is rhetoric, because the actual structure of the financial system makes separation impossible without triggering collapse. Trump was right about one thing. Wall Street is funding the strategic competitor, but he was wrong about the solution, because it's not a problem you can tariff your way out of. It's not a problem you can sanction away. The dependency is structural. It's in the indexes. It's in the passive funds. It's in the VIE contracts that seeing it be unwound without triggering legal chaos across hundreds of companies. The system is faster now, more automated, more globally integrated. The next crisis won't take months to unfold like 2008. It will happen in hours. Algorithm-driven selling, margin calls cascading across time zones, circuit breakers failing to contain panic, And when it happens, the people who engineered this system will already be hedged. They'll have moved their personal wealth into hard assets, real estate, commodities, treasuries. They'll give interviews about unforeseen risks and black swan events. They'll testify before Congress about the need for reform. And your 401k will be worth 40 cents on the dollar. This is the lesson of every financial crisis. The risk is socialized, the profit is privatized. The insiders escape, the public pays. We've seen this movie before. We know how it ends. The only question is whether we're watching or participating. Because here's the thing about denial. It feels safe right up until it doesn't. You can ignore structural problems for years, even decades, as long as the machine keeps humming. As long as your quarterly statement shows gains. As long as the experts on television tell you everything is fine. But the machine doesn't hum forever. Borrowed time runs out. And when it does, the people who trusted the system are the ones left holding the bag. Your retirement isn't diversified, it's captured. Your investments aren't global, they're hostage. And the people who designed this system are counting on you not asking questions until it's too late to matter. So ask the question. Look at your 401k statement. Find the international fund, the emerging markets allocation, the target date fund, read the holdings, see how much is in Chinese equities, see how much is in VIE structures that exist in legal limbo. Then ask yourself, did I choose this? Or was I automatically enrolled in a mechanism I don't understand, designed by people whose incentives don't align with mine? Share this video if you think someone needs to see it. Subscribe if you want to keep following the money, because the official narrative is that everything's fine. The indexes are climbing, the experts are optimistic. The system is resilient. But you know better now. You've seen the structure. You've seen the incentives. You've seen the mechanism. Are we wiser now or walking the same path in better suits? Drop a comment with your thoughts. And let's see if we can have the conversation they don't want us to have. Because your future isn't a portfolio allocation, it's a geopolitical chess piece, and it's time you knew whose hand is moving it.